Greetings, friend, and welcome. AI is not only being used by banks for chatbots or simple automation. It is moving into fraud detection, loan decisions, customer service, compliance, risk scoring, portfolio analysis, payment monitoring, and internal operations. The bank is becoming a model, a system that watches transactions, scores people, flags behavior, predicts risk, drafts responses, routes decisions, and helps employees approve credit, manage customers, and move money through software. Fraud detection is one of the clearest examples. These systems learn what normal activity looks like, compare new transactions against that history, and flag behavior that looks unusual. Modern fraud and anti-money laundering tools can analyze account history, session behavior, counterparty networks, payment timing, transaction speed, and relationships between accounts. The old fraud system looked for known rules. The new one watches behavior. Naturally, this is moving into credit underwriting and loan decision support. Lenders can use models to evaluate repayment risk, detect fraud in applications, analyze income or spending patterns, and sometimes use alternative data such as rent or utility payments. That may expand access for people outside traditional credit systems. It can also turn a loan denial into a model output, where the customer may not know which data mattered, how it was weighted, or whether the system learned bias from older lending patterns. Banking has always depended on trust, but AI makes that trust computable. A customer can be scored in ways that may protect the bank and sometimes the customer. But the same scoring can quietly decide who gets friction, who gets flagged, who gets credit, who gets frozen out, and who gets treated like a risk before they know why. AI is also moving into customer service and portfolio analysis. It can answer banking questions, summarize policies, route service requests, draft responses, support call center employees, scan market data, read filings, evaluate risk, and monitor portfolio performance. When enough institutions use similar models reading similar data, the market can begin to inherit the behavior of the systems watching it. Compliance is becoming an AI workflow too. Banks already rely on large systems for know your customer checks, anti-money laundering monitoring, sanction screening, suspicious activity reviews, investigations, audit trails, and regulatory reporting. Agentic AI research describes systems that automate onboarding, monitoring, investigation, and reporting while keeping audit logs and routing tasks to specific models. Compliance is becoming a workflow where agents collect evidence, summarize cases, route decisions, and prepare reports. The Bank of England and FCA's 2024 survey found that financial firms expected major near-term AI use cases to include internal processes, customer support, and financial crime. Regulators are moving in the same direction. The U.S. Government Accountability Office said financial regulators are increasingly using AI to identify risks to financial institutions and detect insider trading or other illegal activity. In Britain, the Financial Conduct Authority has used AI to reduce some less complex supervisory cases from hours to minutes. The risk grows when financial decisions depend on the same kinds of models and the same small group of technology providers. A recent FCA review warned that shared models, shared infrastructure, or shared vulnerabilities can create correlated failures. The banking system may become faster, but also more synchronized and fragile. A bank used to hold money, move payments, issue loans, and manage accounts. Now it is becoming a scoring machine around the customer. It does not only know what you have, it begins to predict what you might do. And as more customer support moves into automated systems, the human relationship with the bank gets thinner. Less explanation, less judgment, less loyalty, and fewer people able to look at a case and say, something here is wrong. If the bank watches your behavior, scores your risk, flags your transactions, predicts your ability to repay, routes your service requests, and guides internal decisions through AI, who is making the financial judgment? And when that judgment can affect your account, your loan, your payment, or your access to your own money, how much control do you really have? Hold on to your purse. This is Mike Asai, and you're watching the Singularity Hub. Subscribe for more.